Today we have the honor to speak with Lyn Alden of Lyn Alden Investment Strategy. Lyn is one of the most sought after strategists right now, whose legacy lies at the intersection of engineering and finance, and in the amazing ability to turn the seemingly endless market noise into a valuable set of information. Lyn, welcome and thanks so much for your time.
Thanks for having me. Glad to be here.
Lyn, would you be so kind and give our audience a brief background about you and your career?
Sure. Yeah. So I've been interested in investing my whole life ever since I was a kid. But when it came time to go to university, I focused on engineering instead because I also had an interest in technology, and for practical purposes, I found it a good way to go, to start and get a good income, especially at that time because it was kind of around the financial crisis period, and so for the next 10 years, I worked in engineering. But then gradually during that period, I shifted more towards engineering management and running the finances of an engineering facility. And so I kind of blended that background of the technical background, but then over time became more interested in kind of the financials behind engineering. In addition, I had blogs at the time where I would do still investing as on the side. I eventually sold that to a larger publisher. And in 2016, I launched Lyn Alden Investment Strategy, which is basically taking the culmination of what I've learned both from investing and from engineering and applying it towards professional and retail research for people. And so that's what I've been doing since late 2016.
That's fascinating. In your April newsletter, you started your latest analysis of market conditions following the massive deflationary shock from the pandemic using an engineering analogy. Can you describe the mechanism to our audience in a bit greater detail?
Sure. So one of the challenging things for investors over this past 15-year period is taking into account policy response for economic issues that happen. And that's, it's understandable because, for the prior decades, macro played a smaller role. We didn't have to worry too much about big policy responses. But starting in the global financial crisis, 13 years ago, depending on exactly where you wanted to find that starting, we began experiencing around the world, the United States and elsewhere, very big policy responses. They could be, massive asset purchases. They could be, cutting interest rates all the way to zero. In some cases, negative. They could be huge fiscal responses. Like multi-trillion-dollar cash injections into companies or households to keep them afloat. And so, if you kind of just look at the economic data, you can see, okay, we're going to have a big deflationary crash. And then you said, no, back up a second because they can create a lot of money, give it out, and basically that's an inflationary response to a deflationary crash. And so, we're in that period of time where I view it like a control system where, because a lot of my engineering focus was on control analysis. And so basically, if you have like a multivariable system, like let's say like a simple one's a thermometer, right? So if you set it to a certain temperature, you can consider that's the policymakers trying to keep it a certain temperature. And if it gets too hot, it'll cool, it'll kick in a policy response to cool the air. If it gets too cold, they'll try to heat the air. And so as investors, we have to watch out for what policymakers are trying to do because they might not always achieve their goals, but we can see the direction they're going to try to pull things in. And so, if you have a system with 100 variables, that's much harder to track than a thermometer, but you can still get an idea of when it's out of whack and what direction policymakers are going to try to push it in. And so I incorporate expected policy responses into my investment analysis because that's been a very challenging thing for the past 15 years or so. That's one of the ways that I try to really kind of navigate this successfully.
How does this dynamics and control pattern reflect in the various markets, starting with equities, for example?
Well, an example is finding breaking points. And so, when we saw back in late 2018, the Federal Reserve in the United States was, they were doing quantitative tightening, so they were reducing the size of the balance sheet. They're also raising interest rates, and that was fine for a while. But eventually, the market started to get a little bit stressed out. We started to get global GDP, shrinking. It was still increasing, but the rate of change of that growth was rolling over and going down. Because in the United States we had tax cuts that were at that point already done, so we didn't really have more stimulus kind of coming in, and we also had trade issues between the United States and China. We had all sorts of things. Plus, you just get a natural slowdown sometimes, but the Federal Reserve was still tightening. They were still reducing their balance sheet. And in quarter four 2018, the market freaked out. So the S&P 500 fell 20% in a very short period of time. But then actually behind the scenes, there were no junk bonds issued in the United States for 6 weeks. It just credit markets pretty much froze at the risky end of the area. And Powell, the chairman of the Federal Reserve, comes from that background, and so of course he was aware of that. And so we had the famous Powell pivot, where Powell came out and basically said, "Oh, we're going to be data dependent. It's not going to be nearly as autopilot as I suggested it was." And so the market was more relieved. And then later in 2019, we started to get cuts, interest rate cuts, and then we also got an end of quantitative tightening. And so basically, when it comes to watching liquidity in the markets, they can have very big impacts on risk assets, and that can include equities, that can include junk bonds, that can include all sorts of things. But some of the policy responses differ. So back then, we had gold, for example, go up during that period because you had declining interest rates at a time when equities were selling off. So you had that sort of inverse correlation. However, if you look in the crash of 2020 during that March period, because you had real interest rates go up because you had inflation fall even faster than nominal yields, you actually had gold sell off along with equities. And then, of course, during that period, I was kind of looking for the inevitable policy response because we started to see things in the system break. And another example was with FX markets, where there's about 13 trillion in dollar-denominated debt around the world outside of the United States. Multiple countries borrow in dollar-based debts, and they're not actually owed to the United States in most part. It's, for example, Europe loans out dollars, China loans out dollars, Japan loans out dollars. They're often it's a big intertwined mix of who owes who. And many of them, the United States owes a lot of debt as well. That's not even included in the $13 trillion. We owe a lot of debt to foreigners. And so when there's an issue like where global cash flow seizes up, either due to recession or financial crisis or a pandemic, and with an economic shutdown, now suddenly, if you have dollar-based debts, but you can't get dollars because you're selling oil and the price of oil just collapsed, or you're selling goods, but economy shut down, well, suddenly you have trouble paying that dollar-based debts, and you scramble to get dollars in order to cover those debts, and so the dollar spikes relative to other currencies. Now the problem there is that in addition to having 13 trillion in dollar-based debts, the entire ex-U.S. Foreign sector also has over 40 trillion in U.S. assets, and so worst case scenario, some of them can sell U.S. assets in order to get dollars. And now you have some mismatch. So for example, a country like Turkey would have more liabilities than assets, whereas many countries in Europe or Japan, they have way more assets than liabilities, so they can sell dollar-based assets, including treasuries. And so what we saw was that a lot of foreign sectors were selling treasuries, and so we saw the treasury market pretty much crash very briefly and turn very illiquid, which is it's supposed to be one of the most liquid markets in the world. And so the Federal Reserve, that's where we had the policy response, was forced to step in and buy $1 trillion of treasuries in 3 weeks, and basically reflate that, reliquify that market as the buyer of last resort. And so that's the sort of situation we see where if something starts to break in the system, we can identify those bottlenecks ahead of time, kind of estimate where their limits are, and then understand what the policy responses would be. And then you kind of construct like an if-else problem. If anyone's familiar with coding, you can have an if-else thing where it's like you get to a breaking point and you can say, okay, 90% chance this policy response is going to happen. Otherwise, we have this crazy outcome. And so I invest partially around taking into account where the bottlenecks are and where policymakers are kind of forced to step in and change their approach.
Was this massive appreciation of growth stocks one of the consequences of this liquidity crunch?
So partially. So during that particular period, during that March period, even growth stocks fell. They fell less than the value stocks because they were less tied to the economy, but they still fell because gold fell, everything fell because you're pretty much it was like liquidations were happening, margin calls, things like that. Now on the other side of that, as we started to get the market reflating, we had a big fiscal bills around the world. We had that big dollar injection to increase the number of dollars in the system to alleviate that dollar shortage. We started to get kind of visibility on trade, kind of bouncing back a little bit. But for a while, growth stocks dramatically outperformed for a few reasons, and that actually it was above my expectations how wide that gap was going to be. But mainly it happened because investors would say, okay, we have no idea how to model the economy right now. We don't want to own things that are cyclical and tied to the economy, things like banks or energy stocks or industrial companies or restaurants or retail like consumer discretionary products. And so instead, they're like, well, we want to own Zoom, we want to own Apple because people are still going to need phones, they're still going to need computers, they're still going to need software, they're going to be online all the time. That's all they're going to be doing. And so we had this almost like a bubble form where people piled into the technology stocks almost at any price. And so some of them, they like Zoom, for example, they grew a lot, but that their share price grew even more. And then you had other companies like Apple, they didn't really change much. Their growth trajectory pretty much stayed the same, but their valuation doubled because people just wanted to be in the safety of something like Apple. And so we saw that kind of play out. But as we started to get, vaccine announcements and things like that, a lot of investors suddenly realized, oh, we're actually really overweight these overvalued tech stocks, and we've left these other industries for dead. And if we get, some sort of light at the end of the tunnel for this pandemic and these shutdowns, well, then these things over here are actually really cheap. So we've been in periods of these rotations where we had one of the biggest ever, periods of growth outperforming value. But then, starting in that autumn of 2020, we've had, kind of value catching up. Now, but it never goes in a straight line. And so, for example, in the past month, starting around mid-March, we've actually seen growth outperforming value for a period of time again, and it remains to be seen how persistent that's going to be. I think some of the really extreme moves are likely over with. And now we're going to see things grind out over years and kind of keep watching what is the are we going to see infrastructure spending in different countries around the world, because that could play a role. We're also going to see just how investors respond to different valuations. Tech stocks and growth stocks in general tend to be very tied to interest rates, and so they're interest rate sensitive. And so when you take into account a couple of those variables, we can see how that's going to play out. But the growth outperformance was a good example of kind of a weird rolling bubble phenomenon.
And what patterns could be seen in the bond market and the price of gold?
So gold closely follows two things. One is the growth of broad money supply, especially if you adjust it for either gold's rise in market capitalization, meaning that there's a little bit of kind of annual inflation from mining. And so over time, it follows broad money supply pretty closely, but it can deviate around that trend very significantly based on real interest rates. And what I mean by real interest rates is, for example, the 10-year sovereign bond of your country. I often use the 10-year Treasury because dollar's global reserve currency. 10-year Treasury minus the U.S. inflation rate, or minus the TIPS market expectations of forward inflation, and that gives us a real interest rate. And so people often think that gold is a hedge versus inflation, which is only partially true. So, for example, if you're in an environment where inflation is 4%, but treasuries are giving you 7% a year, well, then you have a 3% positive real yield. And so you're actually doing pretty well with your treasuries. You don't mind holding that as a store of value. And the opportunity cost of holding gold, which is a yieldless asset, is pretty high in that environment. And so you generally don't see gold do very well in that positive real yield environment. However, if you had inflation of, say, 2%, but treasuries are yielding 1%, well, now you have negative 1% real yields. And suddenly that scarce yieldless asset of gold suddenly has no opportunity cost, and if anything, has a positive carry. And so suddenly gold is a lot more attractive. And so really what it is it's a hedge against negative real yields, and it basically protects you from that currency devaluation that occurs in periods of negative real yields. And so even if you look back in the 1970s where gold did very, very well, it did very well in two really big spikes. I mean, there was like the big run up to the mid 70s, which is when you had negative real rates go down to like negative 5%. And then it cooled off a little bit. Gold took a breather. It had a big correction. Real interest rates came up a little bit, but then they fell again in the late 70s into 1980, and that's when gold had its big blow off top. And so even in environments where gold does well, it tends to do well in line with what real interest rates are doing. And so what we saw in going up to late 2018 when U.S. Treasury yields went over 3%, we had positive real yields. So real yields were about positive 1%. But then because we had economic growth slowing around the world, including the United States, we saw nominal yields come down faster than inflation. And by August of 2020, we were at negative 1%. And so gold did very well during that call it 2-year period. But then we started to see nominal yields come back up from record low levels. And so they actually went up faster than inflation. And so we saw gold take a correction. It's been like an 8-month correction. And now we're starting to see, however, that inflation's catching up to nominal yields. And so we're seeing that gold's kind of getting a little bit of a floor here. It's bouncing a little bit. We'll see how persistent it is. But ultimately, what it's doing is it's kind of inversely following real interest rates.
Do market volatilities across the spectrum seem to be normalizing lately? What signs of support of such hypotheses, and what signs we need to be worried about?
So we are seeing reducing volatility, and I would attribute that to the fact that markets there's less going on here in 2021 than there was in 2020. So obviously in 2020, suddenly every analyst in the world had to try to model a pandemic into their earnings forecasts, and we pretty much had to write off any short-term fluctuations in earnings. And then we also, of course, had that giant policy response. So you have a multi-trillion-dollar output gap, and then you have a multi-trillion-dollar response to that around the world. And then, so that was a crazy year. And then even in early 2020, I mean, we had in the United States, we had the storming of the Capitol building, we had election uncertainty, things like that. But as we move forward into 2021, we're now looking more towards it's more gradual differences. So, for example, we're monitoring which countries are reopening, which countries are not reopening as quickly, either because they're not vaccinating, they're having more virus issues, or just their own economy is just kind of more sluggish. And so now we're kind of back to somewhat normal market conditions. But we still have very large fiscal responses around the world. So we're by no means normal, but compared to how we were in 2020, things are a little bit less crazy. And so now that could change very quickly. I mean, for example, in the United States, the S&P 500 is extremely highly valued in particular. And so, if you were to get that rolling over, and if you were to get that period of underperformance, that could spark a sell-off and result in higher volatility. So I don't think volatility is like permanently low. I just think it's 2021 is likely to be less crazy than 2020 unless we get some sort of major surprise with virus mutations or geopolitical conflict, something like that. There's always, unexpected things that can happen.
Investor strategy going forward. If broad stock market themes seem to play well last year, what should the mindset of a prudent investor be right now?
So for me, it's largely about diversification, and so my process involves watching various economic indicators in rate of change terms, and so I'm watching things play out. And so if you look at base effects, right? So how things were compared to the 12 months ago period, we're likely to get very good data for quarter 2, right? So inflation's likely to be run hot because you're comparing it to the worst part of the shutdowns last year, especially in the United States, but also many other countries. Corporate earnings for quarter 2 are likely to be great. They're going to be reported, of course, in early quarter 3 because you're comparing it to the worst quarter of last year, and so a lot of that is going to be good. But then as you look out into quarter 3, quarter 4, it's hard to maintain that momentum. And so that's where I think more serious equity corrections could possibly occur, because you've had such a big run up, you've had such high expectations, and now things are starting to disappoint. We've already seen that somewhat play out in some of the tech stocks, where they report earnings, and maybe things didn't grow as quickly as investors were hoping, and so you see some corrections. And by all accounts, they can still be great quarters. They just don't justify extremely high price to sales multiples. And so I think you can start to see that play out in some of the more cyclical companies as well, later this year. And so that's one of the risks I'm watching. Also, potentially, as I mentioned, gold is kind of finding a little bit of a bottom lately, and so that's an area that I'm watching closely. That whole gold and rates complex, because you could see another period of say slowing growth, and then gold kind of inching back up and equities inching down. And so these dynamics are things I'm paying attention to. I'm also watching. I monitor over 30 different countries, to see how their equity markets look, how their economies look, what some of the specific issues that those economies have, and I look for big trends in structural changes. And so, if you look back to the past 50 years, the dollar's had three really big bull and bear cycles relative to other major currencies, and especially in certain decades, those tended to correlate with equity outperformance for the United States, especially the last two. So, for example, the big dollar run up and equity boom in the late 90s, and then secondly, this big period of U.S. equity outperformance in the 2010s. And so those two periods of time were very good for U.S. equity markets and the dollar. And so we've seen that the dollar break its bullish trend. It's very long-term bullish trend, and so I'm watching that to see if there's follow through, because right now we've been in somewhat of a kind of a counter rally, right? So the dollar fell pretty sharply in 2020. It bounced a little bit in early 2021, rolled back over, but it's unclear exactly what it's doing in the grand scheme of things. And if that were to be in a persistent bear market, then we could enter a period where in the 2020s, non-U.S. equity markets in aggregate outperform U.S. equity markets. And so I'm kind of watching for those very big trend shifts at the same time as I'm watching more like, month over month, quarter over quarter rate of change economic data.
Where do you see the most important market fragilities right now? The VIX index has already reached the pre-pandemic levels. Is there a danger in complacency?
I think so. I think one of the biggest risks, especially for quarter three, would be U.S. equity valuations are extraordinarily high. Another big risk is kind of the opposite. So basically, because the U.S., we had a good vaccine rollout, and because we did the largest stimulus, it's been one of the stronger performing environments, and so people have flocked into it, but almost at any cost, right? So the S&P 500, by most accounts, is the second most expensive it's ever been. Only surpassed by the dot-com bubble, and even by some metrics, it's actually higher than the dot-com bubble. So it's kind of somewhere between first and second most expensive it's ever been, and so that's a concern for forward multiples, for forward performance, I should say. Whereas if you look at many other markets, some of them are still historically cheap. Now the problem is that some of those countries have had trouble with say getting vaccines, and so they're still having trouble reopening because their older society members are still vulnerable to the virus, and so we have somewhat of a difference in outcome. And so I think there's still vulnerabilities in some of the fragile currencies around the world, specifically the emerging markets or frontier markets that have a lot of dollar-denominated debt, but don't have a lot of dollar-denominated assets. And so ironically, for frontier markets, a lot of that debt is owed to China, even though it's dollar-based. And whereas other ones, it's owed to Europe, it's owed in some cases to the United States. It's kind of a diverse mix. And so I still see fragility in places like Latin America, but they also, whereas the S&P 500 is one of those things where a lot of things are going great, but it's expensive, and so you have to kind of watch out for rolling over. For some of those other markets, they're beaten down, they're cheap, but they do have real issues, and I'm watching for a potential resolution to those issues. Because that could represent, the next leg higher. If you kind of buy when there's blood in the streets, and then eventually the war ends and the blood's cleaned up, well, suddenly it's a lot. Those asset prices do better. And so I'm kind of watching for places where they've been brought to the breaking point without breaking. And the risk is, of course, that some of them could break. Like you could just see, for example, the Turkish lira just has performed very poorly. And so if investors tried to catch that falling knife a couple years ago, you got burned. And so I'm watching kind of places where it's not going to continue breaking and it's likely to rebound. And that's of course a challenging thing. And it's more about probabilities of getting it right and having diversification so that you're saying, okay, I'm buying high quality, cheap assets, but I'm not going all in on any one asset or one region.
Where is the stock market in terms of the market cycle right now? In the context of any significant market corrections going forward, what early signs should we be most critically looking for in your view?
So a couple things. One is, you know, by many counts it's an unusual cycle because normally when you have a recession, stocks go down,
Yeah.
but instead we had 2020 stocks hit new highs while the economy cratered, and that's of course because of all the fiscal response that we've seen. We basically propped up a lot of things. Retail investors got a lot of money. They just speculated in the stock market, where banks say they normally would have had a lot of credit losses, but instead a lot of their customers were bailed out, and so we didn't really have credit losses, and so we've gotten this sense of euphoria. And so, some of the things I would look to would be, breaking certain trend lines, right? So, as long as there's structural momentum, it's hard to stand in front of that train and just say, okay, now it's overvalued because you'll just get run over. When you start to see when you know something's expensive, then you kind of set your expectations. And if you start to see something rolling over, that's when you can get quite nervous. It could break, it can start to stop having higher highs and higher lows, or it could break below certain moving averages, or MACD can roll over, things like that. There are a variety of indicators, and of course, there are specific technical analysts that they can track those specific turning points more closely. Whereas I'm mostly looking for, things that are appropriately priced and that have improving fundamentals. And so I do think that, for example, the NASDAQ is risky here because it's very expensive. And you have to look for potential, kind of rolling over. And then, some of the other markets, again, we're in an environment where you have to take into account the fiscal response, you have to take into account potential currency devaluations. But that overall, I think we're in an environment where there's more uh, kind of potential in non-US markets than there is in US markets. But, kind of watching that relationship over time. I'm also watching ratios. So I'm saying, okay, I'll chart a line that shows, like, they say, the SP 500 divided by the emerging market index, and I'm kind of watching for potential turning points for where one market starts outperforming or underperforming the other.
You've mentioned the falling dollar. I believe the XY index fell like 10 points in the past year. Where do you see the Dixie end of this year, and where could be the bottom? Is it likely other central banks will allow the US fall much further against their currencies?
Well, that's part of the reason why we had a counter rally in 2021, because we have had some foreign central banks have been more aggressive at holding their rates, at a lower level to try to offset the fact that their currencies were strengthening against the dollar. At the grand scheme of things, it's very hard for other countries to kind of permanently do that because basically the United States has structural trade deficits. And so when we're running the biggest fiscal deficits and we have big trade deficits, and when the Federal Reserve's buying a lot of the fiscal debt, that tends to be pretty bearish for the dollar because those other countries have strong current account surpluses that help prop up their currencies, and so it's actually pretty challenging to weaken them as fast as the dollar in those environments. Now there could be periods of time where you have that counter rally. My overall base case is that I don't think this dollar decline is fully done yet. I think we'll see lower lows before we see higher highs. But I don't know the exact timeline of that. It's something I'm monitoring quarter to quarter. And so I think that, that if you look at, say, quote unquote fair value of the dollar, meaning that it has a balanced trade situation, that could be a dollar index below 80. However, the question is if it's going to get anywhere near fair value anytime soon, or if these imbalances will continue for a period of time. And so my base case is that we'll see lower lows before lower highs, but I'm kind of watching that play out rather than making specific 6-month or 12-month predictions. Just that my overall base case is that we still are in a bear market.
In the 3 to 5 year time horizon, do you still see the dollar falling?
That's kind of I think the 3+ year timeline is where I see, the dollar kind of having that structural decline. And if you
Mhm.
look back, over the past 50 years, like I said, we've had these three really strong dollar bull markets, and then two of them, of course, ended in very sharp dollar bear markets. And so my base case is that we're currently in the third dollar bear market. And you basically, in some ways, we've been in a dollar bear market since 2016, although it's been kind of a flat to sideways, bear market. Another way of looking at it is that we, ever since, kind of the peak, like the crisis peak in 2020, that kind of March April period, we've been in a dollar bear market since then. And so that's kind of how I'm monitoring, and I do think that this could be a 3 to 5 year process playing out. But it's not a sure thing. It's something that I'm monitoring, and of course, there's always things like vaccine differentials, or the potential for conflict of some sort, like some sort of between the United States and China, for example. There's all these curveballs to watch out for, but overall, my base case would be a lower dollar 3 to 5 years from now than it is today.
How have the expansionary policies and the falling dollar been affecting commodity markets? What can we expect in the years to come? Grain prices have reached new 3-year high. Iron ore is breaking records as well. Are these commodity markets moves in line with the targeted CPI, or are they indicating to something more?
Well, so it's kind of a complicated question because you have to go back a little bit in history. So the short end of it is that a weaker dollar should be good for commodities and for emerging markets. But that relationship can be somewhat tricky. And so in many ways, commodities have been in a bear market since 2008. And of course, that's like the broad commodity index. And then you can also break that up and of course isolate different commodities. So some of them are not in a bear market. I mean, beef, lumber, those have reached all-time highs, whereas many of them have not. And so, for example, energy is one of the worst areas that's been in a bear market since 2008. One of its deepest bear markets in history. Whereas other ones like say copper's done very well, but it still hasn't cleared previous all-time highs. Same with many grains; they've done very very well, but they're not at peak all-time highs from years ago. And so that's it. Basically, the last 10 years or so have been an environment of, a pretty strong dollar, pretty sluggish global growth. We had a very strong commodity, bull run in the 2000s decade. And so we cooled off and consolidated for the 2010s decade. So my base case is that, the 2020s will see a weaker dollar and we'll see a stronger commodity market, but that won't be in a straight line. And so I do think that commodities are likely to break out of this, 10-year, more than 10-year bear market that many of them have been in, but not necessarily every single one. So, for example, I could see lumber cooling off while energy picks back up. But of course, in the broad commodity, basket, energy has a bigger, role to play than lumber for the most part. And so I watch things like capex cycles, right? So it's not just about demand for the commodity; it's also about supply of the commodity. And so periods of low demand eventually generally lead to lower kind of capex to bring new supply online. And that's actually one reason why the 2010s were so bad for energy because you kind of didn't see that relationship. Even though commodity prices were low, the United States kept bringing on more and more shale energy, and most of it wasn't profitable. They just kind of, they lit their money on fire. They basically, they paid, $60 a barrel to get, oil at $50 a barrel out of the ground. And so, but investor appetite for that has somewhat weakened, right? And then combined with ESG mandates, and so you have some pension funds around the world or sovereign wealth funds around the world saying that they're not going to invest in energy anymore. And so many of those companies are forced to be profitable. They can only, drill for new oil out of profits they made from drilling oil. And so they're more kind of selective with the types of projects they do. And so I do think that the 2020s could have this, we could put this period of oversupply behind us and potentially enter a period of tighter supply, and of course, that depends on things like other strains of the pandemic, China's economic performance, of course, because they're such a big consumer of energy now. So there's a couple of variables that could throw that off. My base case is that with relatively tight supply and improving demand, that commodities in general will probably have a pretty good decade.
Is energy sector or especially crude oil a good inflation hedge right now?
Well, almost by definition, it's a good inflation hedge because a lot of consumer price inflation is tied to energy. And so over the past decade, we've been in an environment where we've had kind of we've had two very different types of inflation depending on what your expenses are. And so, for example, we've had inflation in healthcare costs, especially in the United States. We've had inflation in childcare costs. We've had inflation in tuition costs. However, goods have been very cheap and commodities have been very cheap. And so, for example, because energy prices are so low, that's allowed a lot of consumer prices to go down. And because of improvements in technology and automation and offshoring, things like consumer electronics have been very cheap. And so we've had deflation in some categories and inflation in others. Now, if you were to get that tighter energy market, that can potentially have those things that have gotten very cheap start to push back up. You can have it's more expensive to ship things. It's more expensive to make things because of course energy is an additive to a lot of the products we use, and so that overall could contribute to higher prices. And so I would expect that that oil would be tightly correlated to consumer price inflation. In addition, we have the electric vehicles coming and potentially taking some market share from oil. But if you look at natural gas, I mean that's largely used for heating and electricity production. We also have natural gas liquids, which are used for additives in multiple products we use. I mean, the computers that we're using to do this interview with, and all the little plastics and parts of that around the computer, for example, are derived from oil and gas ultimately. And so I do think that demand for those will still be pretty persistent in the 2020s, and that could be a component in higher consumer price inflation than we've been accustomed to over the past 10 years.
What is your view about the emerging market investment opportunities like 10 years down the road? Are there any markets to stay away from as well?
So I think overall they're pretty attractive here compared to say U.S. markets. And so if you look at we tend to have each decade has different areas of equity outperformance. And so of course in the 90s you had very good U.S. Equity outperformance. You had the dot-com bubble. Then we rolled over, and the 2000s were a great period for emerging markets. And so we had that big commodity market. We had the rise of the BRICS, the Brazil, Russia, India, China. That was that term that was called. We had very fast growth. But then eventually that hit a peak in 2007, and the valuations became extraordinarily high. If you looked at their CAPE ratios or their market capitalization to GDP, those markets became very expensive. Russia less so, but especially China, India, and Brazil, they became very expensive. And so, their equities in many cases have been in like a 13-year, 14-year consolidation. If you look at the broad emerging markets index, it's kind of gone sideways for about 13 years now, and that's despite the fact that earnings have gotten better. Those economies did continue to grow. However, yeah, they didn't grow as fast as was priced in, and we've had valuations come down back to more realistic levels. So many of them are not exactly dirt cheap, but they're not super expensive either. And some of them, like Russia, are very cheap because there's all sorts of political issues. And so overall, I do think that especially if you were to get a weaker dollar and stronger commodities, you would have pretty good emerging market performance. Now, the thing is, if you look at broad indices, China now makes up, something like 40% of the emerging market basket, based on MSCI classification. In addition, people often, historically, a lot of emerging markets were commodity producers. And so kind of that relationship between commodity prices and emerging markets was tighter back then. Now, I mean, China, a lot of their index consists of technology companies. For example, same thing, Taiwan's a big component in the MSCI index. It's arguably probably shouldn't be anymore. I mean, South Korea is still in the MSCI emerging market index, so is Taiwan, and they're of course very technology focused equity markets. And so between those three, China, South Korea, and Taiwan, you actually have a lot of technology exposure in the emerging markets baskets. So it's not quite the same as a direct commodity play anymore. But overall, I do think that index is likely to do better throughout the full course of the decade than, say, the S&P 500, with certain tail risks that could maybe prevent that from happening. But that would be my base case.
Are you still maintaining your portfolio ratio at about 70-30 in favor of stocks versus bonds and cash?
Pretty much, yeah. I mean, and even the 30%, I have some of that in gold, for example. It depends. I have multiple different portfolios, and
Yeah.
so the most flexible portfolios that I have, where I can go almost anywhere, I generally take some of that bond component and I put some of that into gold, for example, so that I'm not 30% in paper assets. But I do think that that's a pretty decent mix. And it also depends, of course, on how old an investor is and how risk averse or aggressive they are in their assessment.
How can one wrap one's head around investing in the negatively yielding bonds?
Well, that's it. So I personally, because I'm an American-based investor, my bonds tend to be, U.S. bonds, and so those are negative. They're just low, and so they're below
Yeah.
inflation. And that's one
But
reason
in
I
Europe,
yeah, in Europe, I'd be much more concerned. And so, for example, I have a hedge fund client that I do some consultation with in Europe, and they, of course, don't want to hold negative yielding cash and bonds. And so, there's a couple different options. One is, again, you can go more towards gold for that chunk of your portfolio. Another option I've been recommending for investors that understand the approach is to sell some cash secured put options. And the way that works is that, you know, uh, in some sense, what you're doing is selling volatility. But if you kind of incorporate it into a portfolio strategy, when you sell a cash secured put option, below the current market price of that security, you're basically willing to buy it at a certain price if it falls by a certain amount. You're getting paid to take on the obligation to buy it at a certain price, which could be risky, of course, if that equity crashes. However, if you have a portfolio based on rebalancing, right? So you have equities and you have bonds, and if you were to have, the equities go down, you would sell some bonds and buy some equities. That's the way that portfolio rebalancing works. Now, if bonds are unattractive, another thing you can do is say, okay, I'm going to take a part of my bond portfolio and I'm going to use that to sell cash secured puts on certain equities, so that if they fall, that tranche automatically rebalances by being forced to buy those equities. And so I kind of consider it the first wave of rebalancing, where it can't protect you from massive declines, but if you were to get that correction in equity markets, that's kind of the first tranche of capital that automatically goes over, and by allocating it, it gets paid a higher kind of premium yield for those cash secured puts than you would get from just holding it in negative yielding equities. So if you take, say, a 30% exposure to bonds and cash, I might say, okay, we'll put a third of that into gold instead, as kind of just like a store of value. Then we might leave 10% of it in those just for kind of tactical opportunities, and then we might put 10% or 5% into cash secured puts that are kind of our first wave of getting back into the equity market should there be a reduction. So that still overall reduces portfolio volatility compared to, say, a pure equity portfolio, but it's kind of that hybrid between cash versus equities. It's kind of that in the middle segment.
Where would the alternative assets come in your investment strategies? What digital assets are there on your radar right now?
So that depends on the type of investor. And so gold, of course, is classified as an alternative asset. And so I described how I'm using that. Some large pension funds can also use hedge funds or other ways to have these uncorrelated investments that are classified as alternatives. But in addition, I've been bullish on digital assets, particularly Bitcoin, since April of 2020. And so I do think that there's a useful use case for digital assets. Now, it's challenging because they, in many ways, they're a liquidity play, and so if you were to get a liquidity problem like you saw in March 2020, they'd probably do pretty poorly. But in this current cycle of growth, I like allocating a part of a portfolio towards Bitcoin, and there's also a case we made towards Ethereum as well. It's more of an equity-like investment, whereas Bitcoin is more of like a digital gold type investment. So I consider them very different. But overall, I do think that they also serve a useful role in a portfolio, especially because there's somewhat, even though they have liquidity correlations, on the longer term they're somewhat uncorrelated. And so Bitcoin follows its 4-year halving cycle. And so they overall just represent a whole nother axis of analysis. So, as I look at different buckets where I can put capital, I can say, okay, what is U.S. economic data doing? What are equity valuations like? I can look at Europe. I can look at emerging markets and say, what are their economies doing? What are their equity valuations like? I can look at bond equivalents. I can look at gold. I can look at commodities. And then also digital assets represent another bucket that I can say, okay, I can look at the on-chain analysis and see, okay, what's going on here. I can look at what's happening in the ecosystem, and so there are a lot of opportunities there. Another one I found is that stable coin lending is a way to generate some yield, and it's kind of I describe it as equity-like returns, but also equity-like risk, because you're basically your stable coins, for anyone who's not familiar, is that you have like a token that is tied to a currency, often the dollar, but it could be the euro, it could be any currency, and so this represents basically a cryptocurrency wrapper around a normal piece of currency, and then you can lend that in the markets for kind of basically in a similar way that you would if you were lending to equity margin accounts or something like that, except it's based in the cryptocurrency world, and you can get rates of 8 to 11%, in some cases more, but I prefer to stick on the conservative end, kind of the higher quality stable coins and the higher quality markets, and you can get 8 to 11%. But of course the downside is that it's not the same as a bank deposit. You're not fully insured of losses and things like that. However, if you look at the lender very carefully and you only do it for part of your portfolio, you can have uncorrelated returns where there's certain tail risks that can make you lose your investment, but it's somewhat different correlation than compared to, say, investing in the equity market.
Moving to economic conditions and the policies, what would a Fed signal to take away the money printed punch bowl do to the markets right now?
That probably start working their way down in their valuations, and so I would view it similarly to what we saw in quarter four 2018, where if the Fed were to signal that they're going to tighten, then some of the justifications for assets to be as high as they are would diminish, and so that's actually one of the risks we could see later this year, is that if the Fed decides to taper its asset purchases, for example, we could start to see more struggle in equity markets.
Which of the following three indicators should we be most reliably reading into? CPI, asset price inflation, or Fed balance sheet growth, and why?
So I think they all serve their role, and so I prefer. There's kind of nuance to that. So I'd actually propose a fourth option, which is money supply growth, as broad M2. That I think is more useful, because when you have broad money supply growth, I guess taking a step back, if you have increase in the central bank balance sheet, that's not necessarily getting out into the broad economy. Now that generally does get into asset prices, but it's not necessarily getting out into the economy. However, if you have broad money supply growth, that is getting out to the economy by definition. That means stimulus checks are going out, or corporate bailouts are going out. All sorts of kind of stimulus is going out to the public, and their actual balance sheets are, their checking account, their savings account is going up. And so that tends to be inflationary. And then the big question is, does it pour into asset prices, or does it pour into consumer prices? And it could be both. It could be one or the other. It's often one or the other. And so what we've seen over the past 10 years is that it's largely poured into asset prices. And that's partly because we've been in a period of commodity oversupply. And so that helped keep consumer prices lower. But of course, as I pointed out, there's been differentiation. So healthcare, childcare, tuition, basically things that are service oriented have actually had a lot of inflation, whereas anything that's kind of goods oriented, or impacted by technology, or benefiting from low commodity prices, have been disinflationary. So going forward, at first, watch what this broad money supply is doing, and then paying attention to some of the forces that could determine whether it keeps going to assets, which is low interest rates and tons of QE and things like that, or if you start to get commodity shortages and supply shortages and higher rates, well, then you're looking at consumer price inflation. And so I think that we are more likely to see consumer price inflation over the next decade, whereas this past decade has been very asset price oriented.
Withdrawing liquidity eventually could expose who has been swimming without a bathing suit, as Warren Buffett says. How serious the zombification of the economy is, and how big can the wave of insolvencies prove to be, in your view?
I think those are in some ways two separate questions, because I think that the zombification is a very big problem, and I think that it mainly manifests itself in slower GDP growth than we otherwise would have, because we haven't allowed creative destruction to occur, and therefore we've kept lackluster businesses in business longer than they otherwise would be. They could have been restructured, or those jobs could have been moved somewhere else that is more productive. And so I do think that that represents a pretty big long-term problem for the economy. On the other hand, I think that if you were to have a wave of insolvencies, that's when we have to go back and take into account policy response. And so with the system as indebted as it is, I think you'd probably see a pretty short response time, where fiscal authorities and probably central bank authorities would kind of kick into high gear and kind of start offsetting some of those insolvencies. Now, that doesn't mean that you can't have individual insolvencies, right? So you do have to kind of monitor. If you're investing in individual equities, for example, you do want to make sure you invest in companies that are stronger than their peer group. However, I don't think you'd see absolutely massive insolvency at the same time, because that's when because we have money in politics, for example, corporations donate to politicians. You'd also, if they would start laying off people, you'd see more populism, you'd see more civil unrest, and that also forces policymakers to do some sort of response. And so I do think, that you'd have that quicker response, more similar to 2020 than we saw, for example, back in 2008. I think the public has kind of lost its appetite for those 2008 like scenarios and is more likely to clamor for stimulus, especially because they saw it work so well in 2020. So that'd be my base case, is that zombification has long-term implications, whereas a wave of insolvencies is somewhat of a different outcome.
ISM and PMI indicators show that US economy has started running again, yet the Fed keeps buying government and corporate debt full time, keeping its pedal to the metal the same way as in March of last year. How long do you think this accommodation is likely to last? And could these measures, considered extraordinary only last year, become the new normal?
I think their major thing to watch out for is persistent inflation. And so that's actually one of the things I believe that the Fed, when they say that they're trying to do, whereas they're saying that we want to let inflation run hot, and so and especially the way they measure it, which is core PCE. And so when they want to get core PCE on average above 2% for a period of time to offset the fact that it was below 2% for a period of time, they want to have average about 2%. And so I don't think we'll see a ton of tapering until it starts reaching their targets as they measure it. And so we can, of course, debate whether or not those are even good targets to have, whether they should have those targets, whether those are good inflation metrics or not. I don't think they're the greatest inflation metrics, but we know that's what the Fed's looking at primarily. And so, historically, they want to maximize jobs, but they also want to do price stability. And with unemployment still pretty high, especially when you take into account that a lot of people have just permanently left the workforce, right? So even though the unemployment rate officially has gone down pretty far, in terms of the number of jobs in the economy and the labor, the percentage of population that's employed, those are still much lower than pre-pandemic. And so I think they're kind of erring on that side more than they're erring on price stability at the moment. They're saying we're going to let the price stability issue kind of run loose for a little while, and we're going to focus on the jobs. And so I think, they're unlikely to be super, ready to tighten until they start getting inflation as they measure it shooting up, either either way higher than they expect for a short period of time, or moderately above their 2% target for a sustained period of time.
What is your opinion about the central bank fiat currency debasement? How worried should we be about it? And what do you think is the end game there?
So I do think investors should be worried about it, especially if they have large bond and cash positions, because I do think that the 2020s period, regardless of exactly how much inflation we get, I think that inflation rate will be higher than the yield you're going to get on your cash and bonds. And so by leaving investments, in those assets, you're likely to lose purchasing power over the course of the decade. And that could be, from policymakers' perspective, they want that to happen gradually. So maybe maybe you have an average of 2 to 3% inflation while yields are anywhere between negative 0.5% up to 2%, depending on what country you're in. But basically, whatever the number is, you're losing out compared to inflation. On the other hand, you could have bursts of rapid inflation, and so you could have that kind of front run. There could be periods of supply shortages, commodity issues, things like that, where you get a more period of brief rapid inflation. And so I do think that that's an ongoing risk, and that's why it's not ideal to keep a ton of assets in cash or bond-like instruments.
What is your main inflation progression scenario in the underlying deflationist environment?
So in the long arc of kind of human civilization, we have a deflationary outcome in the sense that as we get more and more technology, we get the prices of most things lower and lower. And so that's been kind of a multi-century trend. However, there are periods of rapid currency debasement, usually due to debt bubbles. Basically, debt gets so high that instead of letting those debt bubbles deflate and default, they increase the money supply dramatically, and that kind of undoes some of the debt problem. But of course, if you're holding bonds, instead of being defaulted on nominally, you're defaulted in terms of purchasing power. Same thing for holding cash in the bank. And so I do think that we're probably going to enter, for the 2020s decade, somewhat of an inflationary counter trend to the longer term deflationary scenario that we have. And that, of course, depend partially on what policymakers decide to do. But I think that's, given how much debt's in the system, I think that's what they're going to aim for. And so, one thing to look out for is that in the next couple months, we have very easy base effects. And so when we compare, say, inflation in April compared to inflation of last year, same thing with, May compared to May of last year, we're probably going to get some pretty high numbers here. Now, that'll probably at some point cool off. But I think that the main thing is that there'll be some sort of trend where there's enough fiscal spending to keep the inflation level higher than bond yields. And that could, of course, vary around the world. So, for example, Europe, because they don't have, the countries mostly don't have control of their own currency anymore. They've shared their currency in the euro. They're somewhat less prone to fiscal spending because the countries can't do it unilaterally in the same way that, say, the United States or Japan can. And so depending on what market we're talking about, there's certain political dynamics to watch. And so, for example, in the United States, the U.S. Senate has a very tight Democrats have a very tiny advantage that allows them to pass some of the things, but there's a couple of dissenters, and so there's a couple of things to watch about how much, say, the Biden can get through in terms of stimulus, and that, of course, affects overall inflation. And then we'd have to watch midterm elections in less than 2 years, about a year and a half now, to see how those play out, because that could then start affecting, if you get more of a political gridlock, that could otherwise cool off the inflation for a while. Same thing with Europe. If you're monitoring European inflation, you generally want to monitor that political dynamic to see what sort of fiscal things that they're going to do. Because I think that one of the biggest drivers of inflation will be fiscal spending that is monetized by the central bank.
About the fiscal spending, what do you think about the quantity and structure of fiscal stimuli in the US and Europe?
So I think it's one of those things where, because of the policy response, like because of that feedback mechanism, it's almost inevitable. The problem is, if they would have addressed this decades ago, there'd be ways out of this. But because they've driven interest rates so low, they've driven debt so high. In the United States, in particular, we've driven a tons of wealth concentration. So a very large percent of the population is living paycheck to paycheck, while a very small percent of this population has a kind of a disproportionate amount of assets. Like, the top 1% own like 53% of the equity market, for example. We have this, it's more concentrated than the average European country or Japan and things like that. And so I think because we've kind of pushed society to that level, I think they're likely going to demand more and more fiscal responses. And so that's something that is when you do get that wealth concentration, historically, you do get that populism that comes in and takes some of that back. And so that's, I think, a kind of a long-term dynamic to watch. And it's a reason why I'm finding that financial history, if anything, is very useful for navigating this decade, because some of the things that are happening now are so extreme. They have to look back, multiple decades to find similar periods of time and to see kind of the various scenarios that can work out. And so there's a couple of hot spots to watch. So in the United States, again, it's that wealth concentration, that's demand for more fiscal spending. That's something to watch. In Europe, you want to watch, say, Italy, or populism in certain countries, and how that could affect, say, the euro-wide politics. Whereas Japan, you have you have lower populism, you have pretty low wealth concentration, and so I'm less concerned about populism there, and I think that their fiscal response is likely to be more, gradual over time, and they have the capacity to potentially do more, and so it's kind of a country by country basis that I'm watching.
How are the US infrastructure bill and the federal corporate tax hike outcomes likely to affect the economic conditions?
It's likely to be good for commodity prices in the longer run, because one is you're stimulating the economy, and so you're likely to get higher inflation. But then also specifically, it's commodity driven, and then because if you're, say, redoing the electrical grids, for example, then you need a ton of copper to do that, tons of steel, and so there's that aspect. And I also think that part of the 40-year period of say strong U.S. equity performance we've had, is a lot of that's been driven by lower and lower corporate tax rates. And it's not just the headline rate; it's the effective tax rate that they pay. And so that's gone down and down and down. And if you start to see a bottoming of that tax rate and eventually a little bit higher tax rate, that could start putting an end to the secular bull market that we've been in, especially when you consider high valuations by many metrics. And so I do think that the 2020s could be a period where, in many ways, the 2010s, the stock market did a lot better than the economy. And I think the 2020s could be a period where, ironically, the economy, at least in nominal terms, when you include inflation, that could do better than we expect at the same time as the U.S. equity market does maybe worse than we expect. So I wouldn't be surprised to see that dynamic where there's more inflation, there's more commodity price increases, but then due to tax increases and due to high valuations, equities kind of maybe they go down, maybe they consolidate sideways. It could be kind of kind of a less attractive decade for them compared to a decade where they pretty much just go straight up.
Recently, we have witnessed Biden administration's push for some kind of a global taxation mechanism. How realistic do you think that is?
That's a little bit out of my scope. So something that I'm watching. There are political commentators that could probably give you a better probability of that playing out. I do think it's very interesting and worth watching because they don't want to try to raise corporate taxes and have those corporations go elsewhere. And so in order for that to work, most of the attractive jurisdictions for companies have to be somewhat on the same page. And so I do think this, again, it kind of ties back into the environment where I do think that the 2020s could be a more populist decade. And so it could be there's more political will to put pressure on some of the corporations than there has been over the past decade. So I wouldn't be surprised to see something like that, at least in part, play out.
Before we finish, if you were in charge of both the Fed and the US Treasury, what would be your way out of the unprecedented global debt burden?
I think that's challenging. If I was the head, I'd probably quit my job because I want to do something that has a more fruitful outcome. I think,
Hypothetically.
yeah. So I think, if you were to go back decades, there would have been ways out of this, which is basically raising interest rates, avoiding debt bubbles in the first place. But because we've gotten to such a crazy extreme, pretty much you have to do some sort of currency devaluation and kind of reset that, and then try to have it be better there. So one thing I wouldn't be doing is buying corporate bonds. I wouldn't be trying to bail out zombie companies and things like that. Instead, I'd probably would do fiscal spending a lot of on things that are as productive as possible. Like for example, under the Eisenhower administration in the 50s, the United States built the interstate highway system, which is one of the biggest public works things in the world. But of course, it boosted productivity and standard of living tremendously. And so I would do infrastructure spending, and it would be somewhat inflationary, and it would devalue the currency, but there's almost no way out of the debt bubble otherwise. And so it's one of those things where I wouldn't want to be in that position because I'd be inheriting and something where no matter what you do, you're going to be disliked. But there are certain things I would not do that are essentially kind of propping up certain corporations that really shouldn't exist in their current form. So I kind of have a separation between currency devaluation and just kind of widespread bailouts. I think they're two different things.
For the very end, is there anything you would wish to emphasize for our audience right now? Perhaps besides the fact they probably cannot afford not to invest anymore.
Yeah, it's one of those things. My overall outlook is to remain diversified. I think that's something to watch. I think we're in an environment where the kind of the monetary system as it's been structured since the 70s is potentially shifting. And even going back to your previous question, I mean, the United States has been, ever since the 70s, we've been running very big trade deficits. We've been running, these structural trade deficits, and the rest of the world then takes those dollars and reinvest them back into U.S. assets. But that, of course, it benefits people like me, and it does, that own a lot of assets and that work with information, and it's detrimental to, say, workers, for example. So, one of the things I would do is reduce taxes on labor, for example. I would reduce payroll taxes, and find ways to raise revenue elsewhere. But we'll see if policymakers do that. And so, if they were to do that, I think you could see then a pretty big shift away from how things have worked over the past 50 years. You kind of have, instead of more and more globalization, you have kind of a flatlining of globalization, maybe a pullback in globalization, potentially more inflationary decade, potentially diversification of the types of currencies that are used for global energy pricing and global reserves. And so that can have pretty big impacts on different asset valuations around the world. And so one thing I would do is essentially monitor for bubbles and to keep looking out for what things are cheap, what things are kind of benefiting from a long-term outlook. which is increasingly hard when there's asset bubbles. But I do think that there are some areas like certain commodities that are almost anti-bubbles, that they're basically nobody wants them and you can still find them cheap. And so that's kind of the general approach that I'm using as we go forward.
Lyn, thanks so much for your gracious time and this great talk. Hope we can do this again sometime in the future. In the meantime, where can our audience continue to follow you?
So I'm at lynalden.com. That's where I do most of my work, and I'm also active on Twitter at lynaldencontact. And thanks again for having me.
Thank you. The pleasure was all mine.